Hey, good morning, everyone. Marty Mazur here. It's Wednesday, the 31st of August, 2022, with a quick midweek market technical snapshot for you. We'll look at the S&P. We'll start short term with the 60-minute, and we'll work all the way up through the monthly. So with regard to the 60-minute chart, a couple of things of note here. First of all, this actually is a beginning to look like a bullish, very short-term pattern. Falling wedge, breaking out of that here to the upside. Had a little bit of a bullish divergence building here. Certainly had one here on the RSI. So, it would make sense that we get a little action here this morning. And as I speak, the S&P is up just a little bit. It was up more earlier, and it's come off of that a little bit. Now, backing up here a day or three, and you get what looks like a pretty good bear flag. So you have your kind of your precipitous fall, you get your consolidation and kind of an upward slant. Now you take the length of that flagpole and you come down here, and you're just pretty close, right? You just kind of bottomed right above what would be the length of that flagpole. But again, now the pattern looks more constructive, at least on a very short-term basis. Remember, folks, we're talking a 60-minute chart as we look at it right here. So when we begin to get more meaningful for our purposes, we look at things like the one-year daily chart. And here, not so good. First of all, we pointed this out. We circled this area right here before we got there. Two things, actually three things going on there. Our 4,300 bear market rally target, which we hit on the nose. The 200-day moving average, which we hit on the nose. And then this downward, then the downtrend line, which we also came. So we actually had three levels, our own assessment of how far this market should run, and then these technical indicators, both the 200-day and the downtrend line, boom, and then rejected that just like it should have, and came off of that pretty hard. Now, we did come down, and remember I said there was a pocket between about 4,100 and 4,000 that I didn't really see anything, called it an air pocket, anything that would get in its way. And it took a couple days, but sure enough, we came right through that 4,000, and we're playing with that right now. As I speak, the S&P is at 39.90, and that's right below the 50-day moving average, which is right here. So breaking down below that and then retesting it and rejecting it is not a good sign. It would not surprise me, however, to live here for a little while, at least maybe till Friday when we get the jobs number, and we'll see how that shakes out. And that could move the market in either direction for sure off of this 4,000 level. Ultimately, we think the fundamentals and actually the long-term technicals point us to something lower. A lot of people think that we may test the 3636 on the S&P. Our assessment takes us down to more like 3,500 on the S&P, which is 12 to 15% below where we are right now. So we think there's pain yet to be had in this market, and we don't think it's going to be a long time between here and there. It would make sense to us that we ultimately see those levels or test those levels that we're talking about, sometime in the September, October, November timeframe. So we'll see if that plays out that way. And then quickly go to the weekly. So we'll run a 3-year weekly chart. Remember, we have a 30-year analysis that takes us down ultimately to the 200-week moving average, which now is sloping up, so it's a little above our ultimate 3,500 target there. We did get a buy signal on that nice big rally on the S&P, but that's rolling over, as you can see here on the MACD. The RSI is rolling over as well. The 50-week moving average, which is close enough to the 200-day moving average, so you can see we just popped that, and then boom, boom, 3 weeks down so far. And then the monthly, which we think is maybe the most compelling look. We did that 3-decade analysis of the monthly MACD, sell signals, and when you get it, you're going to typically, at a minimum, test the 50-month moving average, which is about 12+% from where we are right here. And as you can see, we came and we had our downtrend line right here, and it's on an inter-month basis this month, just touched it and then came right off of that. So right now we're threatening to fall back into this trend line right here. In fact, we look like we're right in there. So yeah, you still have a strong sell signal on the MACD. It's beginning to pick up momentum again to the downside. And this one again, outside recession, It's that 15-month moving average technically. And again, very likely could be different this time. But outside of recession over the last 30 years, that's where you find really strong support. That's probably where you should be buying stocks. Now, as regular readers and clients know, we actually believe we're either in recession, but perhaps not, but we will see a recession in the relatively near future. That's our global assessment of conditions right now. But we also see it as a relatively mild one by historical standards. So we think we can probably get away with something 3,500. If we do dip into deeper recession and we really see the consumer pull in, then we're probably talking something notably lower, like 3,000-ish on the S&P. So we're playing it cautious here, rolling our hedges as we need to and so forth, because of course we want to mitigate as much of the downdraft that we think is coming as we possibly can. Of course, we're going to catch some of it, but like we've been able to do this year, we hope to mitigate the lion's share of it as it continues to play out. So folks, that's kind of it for the day. Hopefully useful to you, short and sweet. I could ramble into a lot of different areas, but I don't think I will, and I'll just let you go right here. Hope you have a great rest of the day. Thank you as always for watching and listening. Talk to you again soon. Bye-bye.